Welcome students to another lecture in the series. Let us continue with income from house property in this lecture. Let us begin with deductions from income under the head house property and other provisions. The deductions under this section, income from house property, it is checked under section 24, and I must say at this point deductions under section 24 has been asked many a times as a short note in exam. With effect from assessment year 2002-2003, income chargeable under the head income from house property shall be computed after making these deductions from the NAV, that is net annual value. First is your standard deduction, which is the most important one, a sum of equal sum which is equal to 30% of your net annual value would be deducted on account of repairs, maintenance, collection charges, etc. And this sum is deducted irrespective of the actual amount, whether this amount has been spent for repair, maintenance, or other such expenses or not. This deduction is allowed even if the actual amount spent on such things is nil. So this is being provided to the landlord. Then further, interest on borrowed capital. If the property from where you are earning that particular income is being acquired by taking a loan, then obviously if you have borrowed certain capital in the form of that home loan or that particular commercial property loan, whichever it is, then obviously you will be paying certain interest on it. So where the property is acquired, constructed, repaired, renewed or reconstructed with borrowed capital, then in that case the amount of any interest payable on such borrowed capital will be allowed as deduction from that NAV, so that we can compute the income from house property. So please remember, whensoever income from house property is there under the standard, under the deductions, the most important thing is that you need to remember the section, that is section 24, and the first deduction is standard deduction and the second is the one standard deduction is charged at 30%, remember that also, and the next you have is the interest on borrowed capital. Then further, let us see the certain points which must be considered in respect of the interest on borrowed capital. The interest is deductible on accrual basis, hence it should be claimed on yearly basis even if we have not paid it during that period. Deduction of interest for self-occupied properties and the properties not self-occupied owing to employment at some other place. In that case, the amount of deduction for the interest in such cases will not exceed rupees 30,000. However, the interest up to rupees 1,50,000 is deductible if these conditions are satisfied. First, that if capital is borrowed on or after 1st of April 1999 for acquiring or constructing that particular property. Second, if the capital is being borrowed only for the acquisition or construction of that particular house. Then the acquisition or construction should be completed within 3 years from the end of the financial year in which the capital is being borrowed, and the assessee furnishes the certificate from the person to whom that interest is being payable, specifying the whole amount of the interest. In that case, the bank gives you that interest note which shows all the amount. So the amount of rupees 1,50,000 has been increased to rupees 2 lakh with effect from 1st of April 2015. Then next further that we do need to remember is that interest for pre-construction period. Like sometimes it happens that money is borrowed earlier and acquisition or completion of the construction is taking place in any subsequent year. So meanwhile the interest becomes payable. So in that case the interest which is being paid or payable for the previous period or year in which that property is acquired, constructed, will be aggregated and allowed in 5 successive financial years starting from the year in which the acquisition or construction was completed. In that case, the interest will be aggregated from the date of borrowing till the end of the previous year or previous year which is prior to previous year in which the house is completed, and not till the date of completion of construction. Then further, the assessee took a loan. Suppose here I'm taking an example. Suppose an assessee has taken a loan of rupees 6 lakh as on 1st of April 2012 from a bank for construction of a house, and that particular loan carries an interest of rupees of 10% per annum. The construction is completed on 15th of June 2014. If we count, just check out the period, if it is within that particular period or not. If it started on 1st of April, then 1st of April 2012. If I reach 1st of April 2013, then 1st of April 2014. 2 years are being completed, and beyond that, April, May, June, 3 more months are being used. So 2 years, 3 months. So it is within that time span. The entire loan is outstanding at this moment. The amount of interest for pre-construction period is rupees 1,20,000. The entire loan is outstanding. So we need to compute the interest which is allowable for the assessment in 2015-16. Before beginning here, obviously you need to see if the assessment year is 2015-16. So we need to work out the income which is taxable for the year 14-15. Now the interest for the previous year in which the construction was completed from 1st of April to 31st of May 2015, because it is being completed thereout. So on that rupees 6 lakh at the rate 10% obviously would be 60,000. For the first year they are charging it here. Then further, the interest for the pre-construction period, the one before the construction. So the period from the date of borrowing till the end of the previous year, prior to previous year in which the house is being completed, that is from 1st of April 2012 to 31st March 2014 for 2 years, and it would amount to rupees 1,20,000. So we can simply, because it is 2 year period of 2 years basically, so it will be 60,000 into 2, that is 1,20,000. So what we would do, we would add the 1/5 of which is allowed for the year, like 60,000. Like we can divide it by 5 because it is allowed for 5 consecutive years. So we can add the 1/5 which is allowed for this particular year, that would come out as 24,000. So the total interest which would be allowable is that 60,000 plus 24,000 will give you the amount as 84,000. Then interest when not deductible from interest income from house property. This is being discussed under section 25. The interest on borrowed money which is payable outside India shall not be allowed as reduction under section 24b point. Then unless the tax on the same has been paid or deducted at source, and in respect of which there is no person in India who may be treated as an agent of the recipient of for such purpose. Then further we need to see the treatment of unrealized rent in determining the annual value. Unrealized rent means which was not payable when not but it was payable, it was due but not paid by the tenant, shall be excluded from the rent received or receivable, because we cannot tax an income which has not been received yet. So for that we do have certain rules that we do need to follow for unrealized rent. This shall be excluded from the rent received or receivable only if these conditions are being satisfied. First thing, when the tenancy is bona fide, when it is genuine. Second, the default SSE or the defaulting tenant has vacated, and the steps have been taken to compel him to vacate the property. The defaulting tenant is not in occupation of any other property of the SSE, means he must not have occupied any other property of that particular SSE. The SSE has taken all responsible reasonable steps, basically we can say, to institute the legal proceedings for the recovery of that unpaid rent, and he has to satisfy the assessing officer as well for that legal proceeding. If we are going to do any kind of legal proceeding, that would be useless, because we have already taken the reasonable steps related to the legal proceedings whatsoever we could in order to recover that particular unpaid rent. The unrealized rent allowed as deduction, realized subsequently under section 25AA. Unrealized rent subsequently recovered will be deemed as income under the head income from house property only, and would be taxable in the year of receipt. It has been mentioned earlier that basic requirement for assessment of property income is the ownership of the property. However, in the cases where unrealized rent is subsequently realized, it is not necessary that the assessee continues to be the owner of the property in the year of receipt also. Then further, we do need to see the tax treatment of arrears of rent, section 25b. So if the amount, if there is an amount which is being received in account of arrears, and it has not been charged to tax earlier, will be charged to tax after deducting a sum equal to 30% of such arrears, and it is to be charged to tax in the year in which we have received it, if we have not taxed it before. Such amount is charged to tax whether or not the taxpayer owns the property in the year of receipt. Means it is quite possible that the person must have sold the property in the previous years, but later on the person is receiving that rent which was due. So it is not necessary here at this moment that the person is the assessee is the owner of that property. Quite possible that he might have sold out that particular property. Let us have a look to our question. During the financial year 2016-17, Mr. X received a sum of rupees 1,50,000 for rupees 50,000 per annum by way of arrears for the last 3 years as the government department, the tenant. Basically, here in this question, the tenant was a government department, and they have increased the rate of rent with retrospective effect. Means that they will be paying it from certain period back behind, and from there they will be giving the increased amount, so they will be receiving a lot of money out of it. So will this sum be taxable for the assessment year 17-18? The question that we need to answer is this, and can it spread over the last 3 years? Let us see. We know very well that as per section 25B, the arrears of rent shall be taxable in the previous year in which the arrears are being received. So therefore, the sum of rupees 1,50,000 shall be taxable in the assessment year 2017-18 because it is being received in that particular year, and the assessee shall be allowed to a deduction at the rate 30% of such arrears. So in that case, the net amount would be 1,05,000. Why? Because 1,50,000 minus 45%. 45% is 30% of 1,50,000. So we are subtracting 30% from it, and it would be chargeable to tax under the head income from house property. And it is not necessary that the taxpayer owns the property in the year of receipt. Again, the same thing that we have studied on the previous slide. Then further, we talk about co-ownership here. Section 26 talks about it. Sometimes the property consisting of buildings and the land appurtenant thereto is owned by two or more persons, and they are known as co-owners in that case. So in such kind of cases, if their representative shares are definite and ascertainable, if we know that how much property is being owned by which owner, then in that case the such person shall not be assessed as an AOP in respect of that property, but the share of each such person in the income from the property as computed in accordance with section 22 to 25 shall be included in his total income. And in such cases, the relief which is admissible under section 23 subsection 2 for the self-occupied properties shall also be separately allowable for each person applicable for it. Then further, we need to see that how to treat the loss if it is there from house property. When the aggregate amount of permissible deduction exceeds the net annual value of the property, there will be a loss from that property. So this loss shall be treated in this manner. Let us see. As per section 70, if any person has loss from any house property, such loss can be set off from the income from any other house property. It is called inter-source adjustment or intra-head adjustment. Like for example, Mr. Kumar has two houses. There is loss of 43,000 from one house and the income of 90,000 is there from other house. In this case, the loss from one source, that is that particular house, can be set off from the income of that other house. So you would see further, let us see, as per section 71, if even after the set off, suppose there is some unabsorbed balance of loss which is left, then that unadjusted loss can be set off from the incomes of the other heads. But as per section 58 subsection 4, such loss cannot be set off from casual income. That is called as inter-head adjustment, and we will be studying it in detail in your set off and carry forward of losses in unit 3. For example, Mr. Naqvi has loss from house property of rupees 6 lakh, and income from business he is having is rupees 8 lakh. In this case, the loss is allowed to be set off, but if he has any casual income, then in that case that loss cannot be set off from that casual income. As per section 71B, further the subsection of that particular section, the further unadjusted loss is allowed to be carried forward to the subsequent year, but for a maximum period of 8 years starting from the subsequent to the year in which the loss was incurred. Beyond 8 years, we cannot carry it over, and in the subsequent years, loss can be set only from the income, and in the subsequent years, the loss can be set off only from the income under the house property only. Let us understand this using an example. Mr. X has lost under the head house property of the previous year 2004-5 of rupees 5 lakh. The income under the head house property of rupees 5 lakh is there in the previous year to 12-13. Now check out the year from 2004, 6, 5, 6, 7, 8, 9, 10, 11, 12, totally 8 years. So in this case, the loss shall be allowed to set off because it will be allowed to be carried forward for up to a period of 8 years starting from the previous year. So we can carry it forward. Thank you for this lecture. If you have any queries, do write to me. Take care, study well.